Hello folks, this is Dr. Jeff Camarda with a Market Minute, my weekly market update. This one's called A Word from Jeff from our newsletter, Dead Bull Walking or The Boy Who Cried Bear. Not to pull a Chicken Little here, but it's no secret that I've been expecting a sharp pullback in U.S. shares for some time. While there is of course no guarantee or fixed schedule for this, my thinking is in line with some pretty smart company, including the oft-referenced Dr. Robert Shiller, author of Irrational Exuberance, Nobel Prize-winning economist from Yale, who has been warning about a bubbly U.S. stock market for quite some time, including most of this year. The basic concept is this: stocks represent ownership in companies. We buy companies to share in their profits. High profits and low prices are good. Low profits and high prices are bad. There's a relationship between them. Both pieces, of course, are moving all the time for the whole market and for individual companies. And investors can come to decouple the relationship and consider stocks more like a lottery tickets and less like the cash cows they are or should be. You kind of lose the relationship between we're investing in part of a company that we own and the company's got to make money. That's the objective of it. The relationship between stock prices and profits is best known by the price to earnings or PE ratio, but there are many other and better ways to assess these relationships that I won't bore you with here. But low price to earnings ratio, small price divided by big earnings is good. High PEs, big prices, smaller relative profits are of course not so good. Now the U.S. stock market is muddled by the fact that the economy is still in full recovery mode and many companies' earnings keep going up. That's a good thing unless the stock price escalation gets ahead of the earnings escalation, as many smart people feel has happened in the United States. The graph in the newsletter really helps to tell the story. When stock prices, and please request a copy if you don't have it, you can email me personally, j@camarda.com, or go to our website to request it, camarda.com, of course. But when stock prices go up faster than earnings, value measures like PE get out of whack and eventually come painfully down as the bubble pops and a normal, appropriate relationship is restored. Take note, by various price to earnings measures, prices have not been this lofty since 1929 or 1999, right before the dot-com crash. And both, of course, were market peaks before very, very big drops. It doesn't help that borrowing money to invest in stocks, margin is the most common term for this, is flashing warning signs as well, and margin borrowing is higher now than before the 2000 crash and 3 times the level just before the 2008 meltdown. Make no mistake, U.S. stocks are one of the most expensive markets in history. Amazon, which is the A in FANG, the other tech darlings, of course, being Facebook, Netflix, and Google, now Alphabet. But Amazon makes a great case in point. Yes, it's an incredible organization. I'm not sure how well I'd be able to live anymore without it. It's my go-to source for nearly everything retail. And yes, it's an incredible disruptor, transforming and improving lifestyles in uncountable and unknowable ways. And they're just incredible, the stuff that they're innovating. But the Amazon phenomenon is premised on a rather incredible proposition, and that is if the company breaks even, no profits. Break even, no profits, no return for investors, no real return anyway. It won't pay tax. It can pour cash flow tax-free into expansion and can grow to control the world in record time. Just kidding about that, but not by much. In fact, there's some interesting research at NYU about this, but I won't bore you with that either. But investors love Amazon. No one seems to miss the E, the earnings, the profitability. All expect that a textbook growth stock like this will one day spew enormous profits on the patient investors or their grandchildren that buy the stock. But what if it never does? The stock value in many ways is untethered from the economic reality, but strangely few investors seem to notice this. When a correction will happen, I can't tell you. Long-term viewers or readers know I've been squawking about this for some time, and still the bubble continues to inflate records almost on a daily basis with extremely low volatility. Nobody's worried. But it's making me very itchy, as you can tell, and I wanted to remind you that we are on alert, and you should not be surprised if we get a substantial drop. Also, again, I'm not calling a bear market, and I don't think you should get out of stocks. I think that you should be well diversified across stock markets. And if you're concentrated in U.S. large cap stocks, as so many people, non-Camarda clients that we see on a daily basis are, you should take some risk off the table by spreading things around, particularly into non-U.S. stocks, which look a lot cheaper from a value perspective. They really do. I mean, the economies around the world are pretty much booming, and Europe and Japan just recently hit records, but they're still a more reasonable valuation, when we look at the profitability of the companies, not so for the U.S. Ditto also for diversifying into value stocks, even U.S. value stocks, which by definition have somehow eluded the overvalued froth and still represent solid deals. I apologize for the cough and the lack of a teleprompter today. Been feeling a bit under the weather, but that's enough for now. I'm Dr. Jeff Camarda, hoping this was helpful, and thanks so much for watching.